So good afternoon. Good afternoon. I'm an attorney with the Legal Aid Society, and as an attorney, I want to tell you a little bit about what we do and how we may be able to assist you. We provide transactional legal services to small businesses and nonprofit organizations. And for our small businesses, we can help you with everything from helping you if you have an idea, but you're trying to decide how to structure your business. We can help you with choosing what the best legal structure is, whether it's as a sole proprietorship, whether it's as a corporation, general partnership, limited liability company. We can help you with incorporating the business. We can help you with commercial leasing. We can help you with commercial leasing issues. We can help you with employment issues. We can help you with intellectual property issues, contracts, especially if you are in a business and you have partners. You shouldn't be doing this without having a partnership agreement. So you should have some type of agreement. If you're selling things, you should have a sales agreement, whether it's for the sale of goods or products. So we provide a wide range of services, and those services that we provide will include anything, almost anything that a small business owner would need. The only thing that we don't assist with is we don't assist with helping if you're in a lawsuit or if there's a some type of litigation. But other than that, we can assist with basically most of the other things. So if you need assistance, here's my contact information is on the first slide. You will also receive a copy of this. My understanding is you'll get a copy of this of the slide. So if you have any questions regarding the presentation, or if you have any questions regarding the anything regarding your business, you can feel free to reach out to me either through my direct number or by email. So we've kind of covered this. So we're going to be talking about taxes and tax compliance. And basically, I've titled this Staying Out of Trouble. There are a lot of things that business owners need to do after they form their legal entity. And a lot of times the business owner will form a corporation or a limited liability company. And after they form it, they think that they're automatically protected from lawsuits and from any of the business debts because they formed a corporation or a limited liability company. And that could be the furthest from the truth. Even if you form a corporation or a limited liability company, you still can be held liable. You still can lose your personal assets. You still can be personally sued if you don't follow certain rules. And there are rules regarding corporations and LLCs that I will go through, but there are also things that you need to know about tax, and not filing or paying the proper tax is one way to get yourself into trouble and to lose your limited liability protection. Now, I'm not a tax attorney, so one of the things that you should do, I always advise business owners that one of the most important members of their team is having an accountant. It's important to have an accountant, a good accountant, that's going to help you with all of your tax matters. The information that I'm presenting here is basically for informational purposes, but this isn't a substitute for having a good accountant. And it's always a good practice to go out and to get an accountant to be able to help you with the different tax matters. Because when you have a business, one of the trickiest things is the taxes. So you've got basically taxes from the federal government, the state, and the city. And then you also have taxes on the income of the business, both the income that the business has to pay, which only a corporation has to pay, and also the income that as an owner, whether you are a sole proprietor, in a general partnership, a shareholder, or a member of an LLC, you're also going to have to report the income that you derive from the business. So you're going to have the taxes that the business is responsible for if it's a corporation. For a sole proprietorship, partnership, and an LLC, that income is going to be reported on your personal tax return. And then you're going to have the income that you as an individual are responsible for. You're going to have the sales tax, and you're also going to have taxes on any payments to employees. One of the most important things, and one of the easiest ways to get into trouble, is by collecting payroll and collecting sales tax and not giving it to the government. If you collect this payment and you don't provide it to the government will shut you down, and they could go after you and put you in jail if you don't pay this. They consider this basically, this is their money that you're holding, and if you don't provide it, they will come after you. Now, once again, I can't understate how important it is to have an accountant to help you with your business taxes. So your tax responsibilities are going to depend on what structure, how are you organized? As a sole proprietorship, basically a sole proprietorship is one individual, one person who starts a business who doesn't form a corporation or limited liability company. So any person who engages in any business, whatever it is, selling online, catering, opening up a restaurant, any business that's owned by one person where that individual does not form a corporation or limited liability company, they're automatically a sole proprietorship. And as a sole proprietor, that person and the business are the same. So that individual is responsible for all of the debts and liabilities of the business. If the business owes money, that means the owner of the business owes money as a sole proprietorship. So regarding a sole proprietorship, it's important to look at what are their tax responsibilities. Now, with a sole proprietorship, the individual is going to pay taxes on the income that they derive from the business, but that's going to be reported on their personal tax return. So as a sole proprietor, there's no federal or state level taxes on the business. There's no separate income tax return for the business income. You don't have to file a separate return. The owners are going to report anything that they make, any losses are going to go right on their personal tax returns, both federal and state. The one thing that the sole proprietorship or sole proprietor has to be aware of is that although they don't have to pay separate taxes in the business on the state and federal level, the New York City will charge them an unincorporated business tax of about 4% of the income they make from the business. Now, there are certain exemptions and credits available for businesses that are low income. Businesses that earn income and have to pay the unincorporated business tax have to file form NYC 202 if it has taxable income. And if the income that it generates is going to be more than $1,000, then it has to pay that money to the city quarterly. And the form that you would file will be the NYC 5 UBTI each quarter. At the same time, if as a small business, you expect that you have to pay taxes as well to the state, you're also going to have to be required to make estimated tax payments during the year. You can't wait till tax time in order to make those payments. You're going to have to pay it quarterly. Now, a general partnership is similar to a sole proprietorship, except that a general partnership is two individuals who come together to start a business. So any two people who start a business without forming a corporation or limited liability are in a general partnership. And in a general partnership, the individuals own the business. They can make decisions as they agree. In a general partnership, both of the partners, or as many partners as there may be, are responsible for the debts of the business. So that means that if there are any debts of the business, they're the debts of all of the partners, and each partner is responsible for the full amount of the debt. So for example, if you have three partners and one partner makes a decision, now all of the three partners are responsible for paying that debt. Any of the partners, even though they might be all equal partners, the creditors or debtors can go after that one individual for the full amount of the debt. Now, in a general partnership, similar to a sole proprietorship, it's what's called a pass-through entity, which basically means that the partners are not going to pay taxes on the general partnership. They're going to pay taxes on their own personal federal and state income tax returns based on the income that they derive from the business. So there isn't a separate tax payment that's paid for individuals who are general partners in a business. Each partner is going to declare their earnings from the partnership on their own federal and state income taxes. They may have to file a partnership report with the state on Form IT-204, but they do not have to pay a separate state income tax. They're going to pay the income that they receive is going to go right on their personal tax return. Now, if they're doing business in New York as a partnership, they will have to pay, once again, that 4% New York City unincorporated business tax. And there are exemptions and credits available based on the amount of profit that the business earns. If businesses have taxes, they must file a tax return for the city, which is the new form NYC 202. And once again, similar to a sole proprietorship, if their tax is going to be more than $1,000, they can't hold on to it and pay it at the end of the year when they file their personal tax return. They're going to have to pay those estimated taxes quarterly. Now, if you form a limited liability company and you have multiple owners and you decide to be treated as a partnership for federal income tax purposes, this is all going to apply to you as well. So a limited liability company is a separate entity. And one of the most important things about the limited liability company that it offers limited liability protection. So as long as you open an LLC and you follow the rules for the LLC, your personal assets are protected. The most you can lose is basically what you've invested in the business. Now, there are certain exceptions. For example, if you don't pay taxes, business taxes or taxes that you've collected, sales tax or payroll taxes. If you don't pay employee wages, you might be liable. If you sign documents in your own name, you might be liable. But otherwise, you have protection as a limited liability company. And a limited liability company is kind of a combination of a corporation with the limited liability protection, but without the corporate formalities that we will talk about later on, and the freedom that either a sole proprietorship or a general partnership provides. So with the limited liability company, similar to the sole proprietorship and the general partnership, there's no federal entity level taxation or state level entity taxation. It's a pass-through entity, so you're going to pay federal and state. You're going to pay for your federal and state taxes right on your personal tax return. Owners are going to be taxed directly on what they earn from the business. Now, with an LLC, similar to the sole proprietorship, similar to the general partnership, you're going to have to pay a New York City unincorporated business tax of about 4% on any of the income that you earn from the business. And once again, if you owe taxes to the city for this New York City unincorporated business tax, you're going to have to file form NYC 202. And if you have taxable income beyond $1,000, you're going to have to file estimated taxes quarterly throughout the year. Now, as a limited liability company, this is the only structure where you can choose how to be taxed. So as a limited liability company, when you form it, you generally get a letter from the Department of Tax and Finance from the state saying, how do you want to be taxed? If you are the only owner of the LLC, you can choose to be taxed either as a sole proprietorship or as a corporation. If you have multiple members, you can choose to be taxed as a partnership or as a corporation. So depending on how you choose to be taxed, that's gonna have an impact on the taxes you pay and how you pay those taxes. In New York State, both single member LLCs and multiple member LLCs are also required to pay an annual filing fee. The amount of filing fee you are required to pay depends on the income of your LLC. My understanding, it's going to run somewhere on average. I think people pay a little bit over $90, but it's going to depend on basically how much income the business makes. Now, the filing fee, the annual filing fee is due 30 days after the last day of your taxable year. So if you're on a calendar year, it would be due by the end of January. Any LLC that is a disregarded entity for federal income tax purposes, meaning if you're an LLC and you choose not to be taxed as a corporation, you're going to need to file New York Form IT 204 LL. And if you are an LLC and you have multiple members and you decide to be taxed as a partnership, all of the income is going to be taxed and right on your personal tax return. Now, if you're an LLC, you're going to need to file federal taxes, and depending on how you choose to be taxed, you're going to file a form. So if you're an individual, you're filing Form 1040. If you're a partnership, you're going to file Form 1065. If you want to be taxed as a C corporation, you're going to be filing Form 1120. And if it's an S corporation, you're going to be filing Form 1120S. So a corporation is a separate entity from its owners. A corporation can be owned by one person. One person can be the owner of the corporation. They could be the sole director. They could be the president, treasurer, secretary. But one of the most important things about a corporation is that if a corporation is properly formed and is properly operated, it assumes a separate legal and tax life that's separate from the shareholders. And what this basically means is that if there are any debts or liabilities, it's the corporation that's responsible for these debts, not the individual shareholders. So courts have ruled that corporations are like fictional people. A corporation can be sued and it can sue. It can own property. It can own its bank account, enter into contracts. It can own assets. So a corporation can pretty much do anything that an individual could do. A corporation, but the key with the corporation, in order for you to have that limited liability protection, is that whenever any action is taken by the corporation, you need to make sure that the action is taken by an individual who has responsibility under the corporation, not by you, even though you might be the sole owner, as yourself. So you have to take any action. For example, if you're taking action as a corporation, it needs to be you as a board of director, you as the president, you as a treasurer, you as the secretary. At the same time, it's important that you also take those corporate formalities that every corporation, whether it's just you or whether it's a Amazon or Apple, the rules are the same. Every corporation has to have an annual meeting. Every corporation is run by a board of directors. That board of directors can just be one person. It could be you, but you still have to have a meeting every year where you elect yourself to be a board of director. You have to keep minutes of these meetings. You have to have board of director meetings that are going to authorize whatever action the corporation is going to take. And you need to take minutes of those meetings as well. Now, as I mentioned, a corporation needs to be separate. So you need to keep it separate from yourself, meaning opening up a separate bank account in order to limit your personal liability. Now, tax-wise, a corporation incurs taxes. A C corporation, when you form a corporation with the Department of State, if you do nothing, it is automatically a C corporation. So every corporation starts out as a C corporation. If you want to be an S corporation, there's a document that you have to file with the IRS, which I'll talk about on the next slide. But as a corporation, if you form the corporation and you don't do anything, you're automatically a C corporation. The C corporation is the only entity that pays double taxes. So with the C corporation, the corporation itself is going to pay taxes with the federal government and the state, and then the owners are going to pay taxes on the money that they derive from the corporation. So a corporation is going to pay a federal tax, a state tax, and a New York City general corporation tax. And then the owners themselves are going to pay a personal income tax on the money that they received from the business. So C corporations must file annually, Federal Form 1120. And corporations typically have to pay a New York State franchise tax on an annual basis. And that's going to depend on the type of business and the amount of revenue that the business generates. Now, if a corporation is open at any point during the year, so if you were to form a corporation December 25th, you're still liable for paying at least the minimum franchise tax. And one of the areas where individuals get into trouble is that they form a corporation, but there's no income that's derived from the corporation. So there's no activity. So they don't file these franchise taxes. You're required to file and pay a minimum franchise tax on a yearly basis as long as the corporation is open. Whether there's any activity or not, you still have to pay this franchise tax. Now, you have to pay it until you go through the steps of dissolving the corporation with the Department of State. So most corporations are subject to this general franchise tax, and you file that on Form CT3. Corporations are also subject to a minimum New York City corporation tax. So S corporations are formed the same as with the C corporation, except once you form the S corporation, you have 75 days. If you are under 100 shareholders, you have 100 shareholders or less, everyone who's in the corporation is a citizen or resident, and there's only one class of stock. If you meet that criteria, you have 75 days from the date that you formed the corporation in order to apply for to the IRS to be considered an S corporation. If you form the corporation and you miss that deadline, you have a 75-day period at the beginning of every year to file again for S corporation status. So the way it would work is if you form a corporation and you fail to apply for S corporation status, you're taxed as a C corporation for that year. If the following year you file Form 2553 with the IRS, you then become an S corporation and you're taxed as an S corporation for that year when you file your taxes the following year. Now, if you're an S corporation, that's on the federal level. You then basically need to file with the New York State Form CT6 so that the New York State then treats you as an S corporation in New York. If you're an S corporation, you're going to differ in how you pay your taxes from the C corporation, in that with an S corporation, the shareholders are going to pay on their personal tax return their pro rata share of the income that's earned by the corporation, whereas on in a C corporation, it's going to be paid by the corporation, and you have to file a separate tax return for the corporation. With an S corporation, it's going to go directly on your personal tax return. Now, if you are an S corporation, you are going to have to pay a state franchise tax. And that state franchise tax is going to be subject to a fixed dollar minimum tax based on the New York State tax law. The form that you will need to file is CT3S. Now, all S corporations have to file annually Form 1120S. S corporations are going to pay a limited state tax. But S corporations also pay, the taxes that S corporations pay are less than the C corporations. Now, with an S corporation, you're not paying any federal tax. You're only going to pay tax based on what you earn on your personal tax return. New York City does not recognize S corporations. So New York City requires corporations to pay a New York City general corporation tax. So if you're a sole proprietor, you may be required to pay taxes more than once when you file your tax return. So basically, anyone who earns income is required to file an income tax return once a year. Estimated tax is the method of paying taxes, income taxes and self-employment taxes that are not subject to withholding. So, for example, if you were if you're a sole proprietor, but you may be required to pay this sort of tax that on a quarterly basis. Now, when you're an employer, when you're an employee, the employer is going to pay the employee a check, but with that check, they're going to withhold from every check certain taxes. Now, when you are the owner of your business, you are not going to pay yourself a salary. You're not going to pay yourself, so you're not taking out certain taxes. But if you make over a certain amount, the government doesn't want to wait until April or the following year to have to receive that money. If you expect that you're going to have to pay more than $1,000 in taxes for the tax year, the government's going to want you to make an estimated tax payment. So they're going to want you to make quarterly payments on the taxes that you're required to pay. If you're a new business, it's going to be made based on estimated what your estimated earnings are going to be for the year. If you've already been in business, those estimated taxes paid are going to be based on what you paid in the previous years. So these are the dates when if you have to pay estimated tax, these are the dates when you need to pay them. So the taxes from January 1st to March 31st have to be paid by April 15th. Any taxes due from April 1st to May 31st are due by June 15th. From June to August by September 15th, and September to December by January 15th of the following year. Now, you can pay this quarterly, or you can pay it all at once before that first tax is due. Self-employment tax is basically if you were getting a check and you're working for someone as an employee, the employer will withhold Social Security and Medicare. When you work for yourself, you're not issuing yourself a check, but you still have to take out those taxes, the Social Security and Medicare, and pay it to the government on a quarterly basis. So, as we mentioned, there are different taxes. You have the taxes that you have to pay based on the income that you receive, both the taxes that the business has to pay and the taxes that you have to pay based on you receive And then you have the taxes based on payments to employees. So an employer is required to withhold for an employee's paycheck 6.2% for Social Security and 1.5% for Medicare. In addition, half of it is paid by the employee, half of it is paid by the employer. So the employer is responsible for paying a separate contribution of 6.2% for Social Security and 1.5% for Medicare on behalf of all of their employees. In addition, the employee is required to take out and federal unemployment taxes and deposit that also by the last day of the first month after that quarter. Now, the method for paying these taxes that are taken out depend on how much money the owner is required to pay and remit to the government. If the amount of the employees and the owners' Social Security and Medicare taxes and self-employment taxes are less than $2,500, they can pay this when they pay their taxes on their tax return at the end of the year. If the taxes are $2,500 but less than $50,000, they have to pay these taxes on a monthly basis. And if it's more than $50,000, the payroll, the taxes, Social Security, Medicare, and self-employment, then they have to pay this on a semi-weekly basis. If you have to pay monthly, which I think most people will fall under, you're required to pay this tax by the 15th of the following month. Now, you also may be responsible for the Metropolitan Commuter Transportation Mobility Tax, depending on where you do business. All employers are required who have to pay wages and to withhold wages are required to file Form 941, which is the employer's quarterly federal tax return. Employees have to withhold the appropriate amounts of state taxes from employees' wages, and you have to report this to the New York State Department of Taxation and Finance. Every employer needs to register with the Department of Labor, and the employer needs to maintain certain records for every person that they employ, including their name and Social Security number, when they began the job, when it ended, when they worked, and any other payments made to the employee. The employee is always also responsible for the unemployment insurance contributions, and if there are wages that need to be filed, whether they pay those wages out that month or not, or during that period, they still have to form New York State, file form New York State 45, the quarterly combined withholding, wage reporting, and unemployment insurance return. Now, one of the easiest ways to get into trouble is by collecting this Social Security and Medicare tax from the employees and not sending it to the government. If you collect this payments and you do not remit it to the government, even though you are either a shareholder or a member of a limited liability company with personal liability protection, you will likely be held personally liable for that tax. So you are not protected as an LLC member or as a shareholder of a corporation if you collect these taxes and don't pay it. The same thing with sales tax. So if you hire employees, you are going to be required to comply with certain laws. You're responsible for paying the unemployment insurance, workers' compensation, and disability insurance. And for filing quarterly wage reports, you're also going to have to report to the New York State Department of Labor or the New York State Department of Taxation and Finance and register for the unemployment insurance, the wage reporting, and the withholding of the taxes. Generally, if your business is going to make more than 300 in a calendar quarter, you have to register with the New York State employment insurance law and need to register with the Department of Labor. every employer who's paying wages is going to have to deduct certain taxes and withhold certain taxes and file a return and pay those taxes that have been withheld. And you're going to report to the New York Tax Department. If you have new employees, if you're hiring new employees, you need to report it within 20 days of the hiring. Now, you have an obligation as an employer to pay, as I mentioned, workers' compensation insurance and disability insurance. New York sales tax. So depending on what you're selling or what services you're providing, you may be required to apply for a New York sales tax or a certificate of authority. The form you would file that under would be DTF 17. Now, you're supposed to obtain this sales tax certificate before you engage in the sale of anything that's taxable. And usually this takes about 30 days. So it's something to be aware of. But basically, if you're selling goods or services that are subject to tax, for example, you're selling anything, any tangible personal goods, you're providing certain services, food or drink, you're going to need to get a certificate of authority. And once you get that certificate of authority, you're going to be required to make those quarterly payments, as well as you're going to be required to, if you don't have any payments, you're going to be required to, if you don't make any income on sales, you're still going to be required to file a report. Otherwise, you're going to be assumed, you're going to be given a minimum tax to pay if you don't file that report with how much income you made. Now, if you're not sure regarding how, whether you have to pay sales, New York State and New York City sales tax on either the service that you provide or the goods that you sell, you can check on the New York State Department of Taxation and Finance website. On the upper right-hand corner, you put in publication 750. And when you put in publication 750, you'll get this publication that goes through who's required to pay sales tax and who's not. Now, if you have to pay sales tax generally, those returns are filed on Form ST100 quarterly, unless you have over 300,000 in taxable sales, in which then you're paying monthly. But basically, you're going to be paying according to this schedule. Now, this is basically just a slide on when, if you're a new employer, these are sort of some of the obligations that you're going to have to comply with. You're going to have to get a federal EIN number. You will need probably a sales tax identification number. You're going to have to deal with paying the employment tax. And then for any employees, you're going to have to comply with the immigration laws, completing an employment eligibility verification form, I-9 for each employee. You're going to have to withhold and pay federal, state, and local income tax, federal security tax, the FICA, and the federal unemployment tax. You're going to have to register an employee with the Department of Labor Unemployment Insurance Division and withhold and remit contributions to New York State Department of Unemployment Insurance. And you're going to have to maintain workers' comp insurance and disability insurance to cover workers' injuries. So this last part of this training is going to, or the second part of training sort of covers the mistake that people make when they form a business. They form the business and then they automatically assume that they are protected. And the things you have to do after you form the business, you're not automatically protected. So when you form a business that's a limited liability entity, such as a corporation or limited liability company, one of the reasons for forming it is to protect your personal assets from lawsuits or any losses. For example, during this pandemic, I've spoken to a lot of business owners that signed commercial leases, entered into contracts under their own name. And because it was under their own name, they were personally responsible for the debts of the business. If they had formed as a corporation or a limited liability company, the corporation or limited liability company would be responsible for the debts, not them personally. Now, If you form a corporation or an LLC, that is not enough to guarantee you that you are protected for life. You need to have what's called corporate separateness. You need to keep yourself and your assets separate from the business. So what is personal liability? Basically, personal liability basically means that any individual is liable for the debts, obligations, and violations of the business. So if you are limiting your liability, basically that means that you're going to limit your responsibility for any of the debts of the business. If you don't have this limited liability protection, basically if there are any lawsuits, if there are any judgments, they're going to be able to collect from you personally, not from the business assets. And as a business owner, you want to make sure that you separate. If you're forming a corporation or limited liability company, you want to make sure you separate what belongs to the business and what's part of the business from your what belongs to you. Now, if you're a sole proprietorship or a general partnership, you're going to be responsible for the full debts of the business. But as a corporation or limited liability company, you're protected as long as you follow certain rules. So basically, these are some of the mistakes that I've seen businesses make that could lead to them losing that limited liability protection. They form the legal entity, for example, a corporation, but don't take the steps that are necessary after the corporation is formed. For example, they fail to hold meetings of the board of directors. They don't keep minutes. Any major decisions are not supported by the officers or the board of directors. It's the individual who may be the sole owner of the business. But even if you are the sole owner of the business, you have to make sure that you go through the legal steps of appointing yourself as a member of the board of directors, possibly the only member of the board of directors, and making your decisions for the corporation as a board of director, not in your capacity as an individual. Failing to keep accurate records of director and shareholder meetings, commingling funds. You want to make sure that you're not keeping one bank account for the business and for your personal use. You want to make sure that anything that's business related goes into that business bank account. Anything that's business that has to be paid gets paid from that business bank account, not from your personal credit card. You don't want to be reaching into the business bank account to pay for something personal. If you need to do that, you want to take it out, document why you're taking it out. It could be a salary. It could be that you are taking out profits, put it into your account and pay it from there. You want to make sure you're not commingling the business and personal assets of the business. If you have multiple companies, make sure that the assets of you have multiple bank accounts and you keep everything separate. If you have employees, make sure that the employees are only assigned to one business and they're not working for multiple businesses. Gross undercapitalization basically means that if you own a business, that you have adequate funds to run the business and that you're not running a business that you know is not going to be able to support itself. If you sign a personal guarantee, you're losing that limited liability protection. And when you enter into contracts, it's important that you enter into contracts in the name of the business, the full name of the business. For example, with Corp or Inc. at the end if it's a corporation, or LLC at the end if it's a limited liability company. So what are corporate formalities? Basically, when you form a corporation or a limited liability company, it's considered separate from its owners. And because it's considered separate, and if it's maintained separate, the owners are shielded from any liability and losses that the corporation may be exposed to. So assuming you do what you're supposed to do, and you form a corporation the correct way, and you follow the rules for operating and managing a corporation, the most you can lose is what you've invested in the business and whatever assets the business has. Now, this protection is not automatic. In order for you to have this protection when you form a corporation, you have to follow certain rules. You have to keep the corporation separate. There's certain steps that you have to take. And if you fail to comply with these rules, if you fail to take these certain steps, a court may find that you and the business are the same, and therefore that you are personally liable for the debts of the business. So what are the things that you should do when you form a corporation? When you form a corporation, there's certain steps that you have to take. And if you don't take these steps, you lose that limited liability protection. So as soon as you form a corporation, the person who files the form is called the sole incorporator. That person should adopt bylaws and appoint at least one board of director in order to have an initial meeting of the organization. At this initial meeting, anyone, and by the way, when you form a corporation, you automatically get 200 shares. So at this initial meeting, shares are going to be issued to whoever is entitled to shares. You're going to determine how many board members and set the number of board members, which can be one. You're going to nominate and elect the initial board of directors or director. You're going to nominate and elect the corporate officers, president, treasurer, secretary. And once again, one person can be the sole shareholder, the sole board of director, the sole president, treasurer, secretary. You're going to authorize the opening of a bank account, designate the corporation's fiscal year, which is usually January 1st to December 31st, but it doesn't have to be. And you're going to approve adoption of the bylaws. Once you have a corporation, you have to follow the bylaws. Every corporation has to have bylaws. Those are the internal rules of how the corporation is going to be run. So the bylaws are going to have how meetings are going to be conducted, who can vote, how voting will be done, when to have the annual meeting, what's the process for having an annual meeting, what's the process for having special meetings, for elections, for appointing officers. All of these things will be in the bylaws. If you fail to follow through with the bylaws, you might be personally liable as a shareholder. You want to make sure you set up a separate bank account. Every business should have a separate bank account just for business. And you want to maintain separate records. Even if the owner of the business is only one person and that person is 100% owner of the corporation, the only shareholder, you should still have separate financial records for the business. You don't want to mix the business with the personal funds. You don't want to mix anything that's not part of the business with the business, because if you do, then you lose that limited liability protection. So once you form a corporation, you want to make sure you're holding meetings. You have to hold at least an annual shareholder meeting. You want to make sure, even if there's only one owner, you want to make sure you have this annual shareholder meeting. Once again, the shareholder, the board members, and the officers can all be the same person having different and multiple roles, but you want to make sure that when a corporation is taking any action, it's that individual acting in the appropriate role, taking the action. So if one person is the owner of the corporation and that person is the shareholder, board of the director and officer, that person is going to be meeting with themselves and nominating themselves to be the sole board of director and then appointing themselves to be president, treasurer, secretary. That is okay. It's fine, but it's important that it happened. The problem is if you don't do it because then any action taken by the corporation was not properly made, if it's not made by someone who's a board of director who was elected by the shareholders holding a majority of the shares. You should keep minutes of all meetings. Board of directors, any major decisions need to be made by the board of directors at a board of director meeting. So for example, obtaining a loan, opening a bank account, hiring independent contractors, employees, signing a lease, all of these things should be made by the board at a board of director. If you are the sole board of director, basically it's more you sitting down and record keeping, that you're having a meeting, documenting that you were there, and basically the decision you take and dating it. One of the most important things is you have power as a board of director, assuming you get elected by the shareholders. The shareholders are the owners. What signifies ownership is issuing shares or stock. So you need to make sure that you issue shares of stock to yourself. That's going to give you the power, and that's going to illustrate that you're an owner of a corporation. And then you want to make sure that any decisions you make is you as the owner electing a board and that board properly making the decisions. If you have multiple shareholders, you want to make sure you have a stock ledger and you want to make sure you reflect how many shares they own and have information regarding those shareholders. Now, when you form a corporation, make sure that any decisions and any contracts that you enter into are in the name of the corporation, not in your personal name. Make sure you have limited liability insurance. And if you have to sign any contracts, try not to personally guarantee the debts of the corporation, and do not offer to pay personally those corporate debts. Now, I understand sometimes it's not possible. For example, if you signing a commercial lease in the name of a corporation, you're probably still going to have to sign. You're probably still going to have to issue a personal guarantee, but try to limit that guarantee. So if you're an LLC, you're going to have a lot less corporate formalities, but you're still going to have some corporate formalities. In an LLC, you have to have an operating agreement. That operating agreement, it has to be done within 90 days of forming. And the operating agreement, similar to bylaws, it's going to be the internal governance of the business. It's going to say basically how decisions are going to be made. The operating agreement should have several things. It's going to have who the members are and what the percentage is, who are the managing members or managing member, who's going to make the decisions, what are the powers and duties of the members and managers, how profits and losses are going to be distributed, will there be meetings held and how often, and how does someone transfer their interest if they want to, for example, get out of the LLC. If you're an LLC, you want to make sure, once again, that you're doing business through the LLC and in the name of the LLC. Anything that you put out should have the name of the business, similar if it's a corporation. So, for example, if you have any letterhead, it should have the full name of the business, including the LLC. If you have a website, it should have the full name of the business, including the LLC, social media. If there are any contracts, if you're engaging in any transactions, it should have the same name, and you want to make sure you use the same name that's approved by the Department of State. You also want to make sure that you maintain a separate bank account for the business. Anything that relates to the business goes into that account, and you're not commingling either. Now, similar to a corporation, you want to make sure that you're not commingling any personal and business funds. So payments to the business should not go into your personal account. Personal credit cards should not be used for business expenses. Any profit, salaries, or money that you receive should go through the company first and then issued by the company to you. And company funds should never be used for personal purchases. Keep sufficient and accurate organizational records. Maintain good records. Keep separate records. And that is the presentation. If you have any questions about the presentation, if you have any questions about your business or you need legal assistance, this is my direct number to the office, and this is my email where you can reach me. So at this time, if anyone has questions, I will take the questions at this time.
Hi, Rolando. So I have a question.
Yes.
If a business is currently operating as a sole proprietorship or general partnership, what will be that initial step in order to change the structure to a LLC or corporation?
Okay, that is a great question. So for a lot of people, it makes sense to start out as a sole proprietorship or a general partnership because there's not a lot of risk. And when they're starting out there, and some people aren't sure if the business is gonna last, or they're not sure if it's something that they're gonna be in 6 months down the line. So it makes sense to start out as a sole proprietorship or a general partnership. Once you decide that there's more risk or that you want to make this permanent, then the next step to form a corporation or limited liability company is basically filing a document with the Department of State. And you could do it online, and the website is dos.ny.gov. On that website, if you're forming a corporation, you're filing a certificate of incorporation. If you're filing for an LLC, you'll be filing an articles of organization. It's a fairly simple process, probably doesn't take more than 5 or 10 minutes. It's the documents that come after it, and it's the things that you need to do after it that sort of require a little bit more work. But if anyone needs assistance with that, I'll be happy to talk to them about it and guide them through it.
Okay.
But it's a great question, because there are a lot of times that there are people who should not be operating a business that's risky as a sole proprietorship. I see people filing operating a restaurant, a deli as a sole proprietorship, and there's so much liability there. Someone could come in and slip and fall. They can have an issue with an employee. They're signing a commercial lease and they might owe money based on a commercial lease. So a lot of people may start out as a sole proprietorship or in a general partnership, but at some point it's a good idea to transition over.
Thank you.
You're welcome.
And we don't have any further questions. So pretty much wrapping up here.
Yep, and right on time, right? Just about right.
Perfect. All right. Well, thank you so much, Rolando. And again, his contact information, we're going to be sharing this via email as well, this information. So thank you.
Thank you. I wish everyone luck. And if you need assistance, feel free to reach out to me.
Bye. Have a good day.
Bye-bye.